Peter Lynch is a legendary figure in the world of investing, known for his extraordinary success as the manager of the Fidelity Magellan Fund. During his tenure from 1977 to 1990, Lynch achieved an average annual return of 29.2%, making the fund one of the best-performing mutual funds in the world. His investment philosophy is celebrated for its simplicity and effectiveness, focusing on the idea that ordinary investors can achieve great results by leveraging their everyday knowledge and experiences. Lynch's approach is built on the belief that individual investors have a natural advantage over professional analysts. He argues that by paying attention to the products and services they encounter in their daily lives, investors can identify promising opportunities before they become widely recognized. This philosophy is encapsulated in his famous principle, invest in what you know. It empowers investors to trust their instincts and observations as valuable tools in the investment process. By understanding these concepts, readers can gain insights into how to apply Lynch's approach to their own investment endeavors. Let's begin by examining the core principle that underpins his entire approach, investing in what you know. The invest in what you know principle is perhaps the most well-known aspect of Peter Lynch's investment philosophy. This concept encourages investors to use their everyday experiences and observations as a foundation for making investment decisions. Lynch believed that individual investors have a unique advantage because they are often the first to notice trends and products in their daily lives. By investing in companies they are familiar with, investors can leverage their personal insights to make informed choices. One of the key benefits of this approach is that it allows investors to focus on areas where they have a genuine understanding. For example, if you frequently shop at a particular retail store and notice that it is always busy, you might consider researching the company's stock as a potential investment. Lynch emphasized that by sticking to industries and companies that you know well, you can reduce the complexity and uncertainty often associated with investing. By paying attention to consumer behavior, product trends, and business developments, you can identify opportunities that may not yet be on the radar of professional analysts. In the next section, we will explore real-world examples of how Lynch applied this principle to achieve remarkable success. Peter Lynch's investment success is filled with examples where he applied the invest in what you know principle to great effect. One of the most famous stories is his investment in Dunkin' Donuts. Lynch first became interested in the company not through complex financial models, but by observing its popularity and consistent customer traffic. He realized that the company's strong brand and simple business model had significant growth potential, leading him to invest early and profitably. Another notable example is Lynch's investment in Hanes, the clothing company known for its hosiery and underwear products. Lynch noticed that Hanes was introducing a new line of pantyhose that was gaining traction in the market. His wife and her friends were enthusiastic about the product, which prompted Lynch to investigate further. He discovered that the company's innovation and market strategy were strong, leading to a successful investment decision. These examples illustrate how Lynch's strategy was rooted in practical, everyday observations. In the following sections, we will delve into the key principles that supported his investment decisions, starting with fundamental analysis. Fundamental analysis is a cornerstone of Peter Lynch's investment philosophy. It involves examining a company's financial health, business model, and market position to determine its potential as an investment. Lynch believed that thorough research and analysis were essential for making informed investment decisions. One of the key aspects of fundamental analysis is evaluating a company's financial statements, including its income statement, balance sheet, and cash flow statement. These documents provide insights into a company's profitability, debt levels, and overall financial stability. Lynch advised investors to look for companies with strong earnings growth, manageable debt, and a solid track record of financial performance. In addition to financial metrics, Lynch emphasized the importance of understanding a company's business model and competitive landscape. This involves assessing the company's products or services, its market share, and its ability to maintain a competitive edge. By combining these elements, investors can gain a comprehensive understanding of a company's potential and make more informed investment decisions. Section 5. The concept of intrinsic value. Intrinsic value is a fundamental concept in Peter Lynch's investment approach. It refers to the true worth of a company based on its financial health, growth prospects, and market position. Lynch believed that by determining a company's intrinsic value, investors could identify stocks that were undervalued by the market and thus represent good investment opportunities. Calculating intrinsic value involves analyzing a company's future earnings potential and the risks associated with its business. Lynch advised investors to look for companies with strong growth prospects, and the ability to generate consistent cash flow. By comparing a company's intrinsic value to its current market price, investors can determine whether a stock is undervalued or overvalued. One of the tools Lynch used to assess intrinsic value was the price-to-earnings, or PE ratio. This ratio compares a company's current share price to its earnings per share, providing insights into how the market values the company's earnings. By considering both quantitative and qualitative factors, investors can gain a more comprehensive understanding of a company's true value and make informed investment decisions. Section 6. Long-term perspective in investing. A long-term perspective is a crucial element of Peter Lynch's investment philosophy. He believed that holding stocks for the long term allowed investors to benefit from the compounding growth of a company's earnings. Lynch argued that short-term market fluctuations should not deter investors from their long-term investment goals. Lynch's long-term approach was based on the idea that successful companies would eventually be recognized by the market, leading to increased stock prices. By staying invested in these companies, investors could capture the full potential of their growth. This perspective requires patience and discipline, as it involves resisting the urge to react to short-term market volatility. One of the key benefits of a long-term perspective is the ability to ride out market downturns. Lynch noted that market corrections and bear markets are a natural part of the investment cycle. In the next section, we will explore the role of diversification in Lynch's strategy. Section 8. Practical steps to apply Lynch's strategy. Applying Peter Lynch's investment strategy involves a combination of research, observation, and disciplined decision-making. One of the first practical steps is to start by researching companies and industries that you are familiar with. This aligns with Lynch's invest in what you know principle, allowing you to leverage your personal experiences and insights in the investment process. Begin by identifying companies whose products or services you use regularly. Consider the quality, popularity, and potential for growth of these products, and investigate the company's financial health and market position. This initial research can help you identify promising investment opportunities that align with your understanding and interests. Another practical step is to observe consumer behavior and market trends. Pay attention to shifts in consumer preferences, technological advancements, and emerging industries. Finally, it's important to remain disciplined and patient in your investment approach. Section 9. Conclusion and key takeaways. Peter Lynch's investment philosophy offers a timeless framework for achieving success in the stock market. By focusing on the invest in what you know principle, Lynch empowers individual investors to leverage their unique insights and experiences. This approach encourages investors to trust their instincts and focus on areas where they have a genuine understanding, reducing complexity and uncertainty in the investment process. Key components of Lynch's strategy include fundamental analysis, intrinsic value, a long-term perspective, and diversification. By conducting thorough research and analysis, investors can identify companies with strong growth potential and determine their true worth. A long-term perspective allows investors to benefit from the compounding growth of successful companies, while diversification helps to mitigate risk by spreading investments across different sectors. By observing the world around them and focusing on what they know best, investors can make informed decisions and achieve their financial goals. With knowledge and confidence, you can navigate the stock market and build a successful investment portfolio.